Which spouse IRA beneficiary option should you choose? Hi, welcome back to another Money Not Math conversation. This is Money Not Math conversation number 143. I appreciate you coming back. It is Thursday, May 25th. And I hope today's conversation brings you value as we discuss which spouse IRA beneficiary option should you choose. Because if you have an IRA or a 401k of any sort, you have to determine who your beneficiary is going to be once you're gone. And with that, if it's your spouse or if it's not your spouse, there are rules that apply around taxes and things like that that can dramatically affect the value of the money you're leaving behind to the beneficiary that's receiving it. So it's important to understand what your options are, and it's important to have a plan for how you're going to actually provide the most value to the people you're leaving money to, so that they don't just end up getting a massive tax bill or being unable to utilize the money as you'd hope they would be able to. So the Secure Act 1.0 adds new considerations for spouse beneficiaries. The spouse beneficiary is among the few eligible to take required minimum distributions from inherited accounts over their life expectancy rather than within 10 years. Because with the Secure Act changes, if you leave money from a 401k or IRA or tax deferred account to anyone but your spouse, they only have 10 years to spend that money, which can make a massive impact on their tax planning. So your spouse beneficiary has three options. They can have a beneficiary IRA, they can treat it as their own, or they can roll over to their own. We're going to highlight all of those options and the pros and cons of each in a little bit here. When it comes to choosing the right options, Denise Appleby, the writer of this article from Morningstar.com, says ultimately which option is right for a spouse beneficiary depends on their beneficiary profile, including whether they need to avoid the 10% additional tax and or minimize distributions. So it's extremely important what the goal is with this money for your spouse and what your goal is when it comes to leaving money and who you're leaving it to. The disclaimer, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. So those are the highlights. Let's jump into the article and see if we can provide some good value for you either now or in the future when it comes to your retirement and estate planning. So here's the article written by Denise Appleby in Morningstar.com titled, "What is the right option for a spouse IRA beneficiary?" I'll include the URL if you want to read the full article yourself, because I know some of this stuff can get confusing. And, later on, I'll share my screen when it comes to some life expectancy tables and things like that, in hopes that the visuals will make this easier to understand. So jumping into the article, the election by the spouse beneficiary of an IRA will affect the rate at which distributions must be taken and the income tax owed. Two very important things there. Distribution is how much money can be spent. Taxes owed is obviously how much you got to pay to the IRS or your beneficiaries in this example. And with the new restrictions explained under the proposed required minimum distribution regulations for Secure Act 1.0, the timing of elections is now added to the list of considerations for the decision-making process. Sometimes the decision must be made before the spouse beneficiary accepts ownership of the IRA. So that would mean they have to determine which of these three options they want before they receive the money left behind by you or someone passing away. Some background. The Secure Act signed into law on December 20th, 2019, so almost 4 years ago now. It's 3.5 years ago. It's kind of crazy how fast time flies, considering how much of a change this made. Changed the distribution options for beneficiaries of IRAs and employer plans. Under these changes, the spouse beneficiary is among the few eligible to take required minimum distributions from inherited accounts over their life expectancy. But the spouse beneficiary remains the only one who can move inherited IRAs to their own IRA or employer plan account, right? So to catch that, the spouse beneficiary is among the few eligible to take required minimum distributions over a lifetime rather than a 10-year period. And they're the only ones that have the opportunity to move an inherited IRA to their own IRA or an employer plan account. The Department of Treasury and the IRS published proposed RMD regulations, so RMD is required minimum distributions, on February 24th, 2022, which explained that a new deadline now applies to when a spouse beneficiary may elect to treat inherited IRA as their own. These proposed RMD regulations also limit a spouse beneficiary's ability to use the 5-year rule or the 10-year rule and then switch to their own IRA to avoid taking beneficiary life expectancy distributions. But even with this new limitation, the spouse beneficiary still has three options. Number one, beneficiary IRA. Number two, treat as own. And number three, roll over to their own. So RMDs from a beneficiary IRA are calculated using a single life expectancy table, using only the age of the spouse beneficiary, or in cases where the owner died on or after their required beginning date, or RBD, the longer of the life expectancy of the decedent or spouse beneficiary. So I'm going to share my screen here quick so you can see what that looks like. So sharing my screen. And here is the single life expectancy table example. So I'm getting this from fidelity.com. So if you're 0 years old, they expect you to live about 84.6 years. That's your life expectancy factor. You're 41, they expect you to live about another 44.8 years. If you're 82, they expect you to live about another 9.9 years. So congratulations, the older you get, the older they expect you to live, because they're never going to assume you're going to die tomorrow, right? And if we jump to like 100, they expect another 2.8. 100, if you come all the way down here, 120 plus, they give you 1 year. So basically, if you live to 120, they're going to force you to distribute a large chunk of your money on an annual basis because they want their taxes, right? So that's the single IRS single life expectancy table. Let's just use this age 82 as an example to compare against the uniform lifetime table that we'll talk about here shortly. The life expectancy factor at age 82 is 9.9. So if we jump back to the article, the single life expectancy table produces RMDs that are significantly higher than the RMDs calculated using the uniform lifetime table. So that's what we're talking about here. So at age 82, single life expectancy table, life expectancy factor is 9.9. The uniform lifetime table, age 82, the life expectancy factor is 18.5. And if we look at how that matters, and again, I know this is a lot of numbers, so please reach out if you have questions or want to have a conversation about your situation. Hopefully this gives you a general outline that could be helpful, or at least intrigue your thought to take some action. So if you have a $100,000 account balance, as an example, as of December 31st of last year, you divide it by your divisor, which is the number associated your life expectancy factor. So if your life expectancy factor, their example is at age 76, life expectancy factor is 23.7. Well, 100,000 divided by 23.7 is about $4,219 of required minimum distribution. So that's money that you are required to withdraw whether you want to or not. That is money that you're required to pay taxes on whether you want to or not. So that they're using 76. We go back to the single life expectancy table. At age 76, it's 14.1 versus the uniform life expectancy table is 23.7. So using 14.1 is our number. Instead, pull the calculator here, 100,000. Sorry, having some technical issues here with seeing the parts of my screen I want to see. 100,000 divided by 14.1. That's going to be $7,092 a year that you are required to distribute at a minimum. You're required to pay taxes on that at a minimum. If you're using a single life expectancy table, whereas a uniform life expectancy, it's 4,219. So that's a pretty significant difference when it comes to what you're required to do, especially if this $100,000 account balance is $1 million or more. All right, so I'm going to stop sharing my screen. Hopefully that gave you a general outline. Like I said, I know that's a lot, so reach out if you want to talk about your specific situation or if you have questions. Continuing on with the article, the beneficiary IRA option, but that's a good point there before I move on of why it's important to know your options, because one option is almost twice as much as the other option, right? So if we just make blind decisions without having all the information available to us, it could have a significantly adverse effect on the outcome of our planning. So option one, the beneficiary IRA option. The spouse beneficiary who chooses the beneficiary IRA option would transfer the amount to an IRA registered in the name of the decedent and the surviving spouse. For example, Sharon Smith as beneficiary of Mark Smith. The beneficiary IRA is also known as an inherited IRA in the IRA industry. The IRA custodian must input Code 4 death in Box 7 of Form 1099-R. Code 4 informs the IRS that the distribution is exempt from the 10% additional tax on distributions made before age 59.5, known as early distributions. This automatic qualification for the exemption from the 10% additional tax is one of the reasons why the beneficiary IRA option should be elected for a spouse beneficiary under the age of 59 and a half. This benefit is lost if the spouse beneficiary moves the inherited IRA to their own IRA. So this is extremely important for two reasons. First, take some specific tax filing work to make sure you aren't charged 10% of your a 10% tax penalty for early distributions, which is probably a good reason to maybe hire someone to file your taxes if you aren't an expert. And second, if you're under age 59 and a half, this is really important if you want to avoid paying those early distributions. So it's, again, important to understand what your options are. This spouse beneficiary who keeps the assets in a beneficiary IRA must take annual RMDs over their life expectancy if the 10-year, 5-year if owner died before 2020 rule does not apply. All right. So these annual required minimum distributions must begin by December 31st of the year following the year in which the IRA owner died, or the year in which the IRA owner would have been required to start taking RMDs had they lived, whichever is later. The life expectancy RMD for the beneficiary is calculated using the single life expectancy table, which is the higher of the two we talked about. The 5-year or 10-year rule applies under the terms of the IRA agreement or election by the spouse beneficiary if the IRA owner dies before their required benefit date. Under the 10-year rule, distributions are optional, no required minimum distributions until the 10th year after the owner's death. And the balance must be distributed. The 5-year rule is similar, except that the final year is the 5th year. That's a whole bunch of hogwash right there, kind of marshmallowy. So hopefully, if you were able to follow that, it was helpful. And if you weren't, you at least get the impression that there's a lot of options and there's a lot of rules. So it's important to really dive in and look at what your options are before you're making decisions. Second option, the treat as own option. A spouse beneficiary may elect to treat an inherited IRA as their own if they are the sole beneficiary and have an unlimited right to withdraw amounts from the IRA. The election to treat an inherited IRA is made by the surviving spouse redesignating the inherited IRA in their name. The name of the decedent is not included in the registration. Not taking beneficiary required minimum distributions within the required time and or making a regular IRA contribution or 60-day rollover contribution of the inherited IRA result as a treat as own election, treat as own. However, I am unaware of any IRA custodian that permits regular IRA contributions to be made to inherited IRAs, says the writer of this article. The code in box 7 of the IRS form 1099-R is driven by age and whether the spouse beneficiary qualifies for any certain exceptions to the additional tax on early distributions. Code 1, early distribution, no known exception, is used if the spouse beneficiary is under age 59.5 and the distribution is not made under any of the following circumstances. Due to an IRS levy, while the IRA owner is disabled, for conversion directly to a Roth IRA under a substantially equal periodic payment program. So let's read that again. Code 1, early distribution, no known exception, is used if the spouse beneficiary is under age 59.5, and the distribution is not made under any of the following circumstances. 1, due to an IRS levy. 2, while the IRA owner is disabled. 3, for conversion directly to a Roth IRA. Or 4, under a substantially equal periodic payment program. Otherwise, Code 2, early distribution exception applies would be used, except for disability, where Code 3, disability would be used. Code 7, normal distribution, is used once the IRA owner reaches 59.5 and is therefore generally free from the 10% additional tax and distributions. So there's 2 important points highlighted here again. 1, this is kind of complex, confusing stuff, so I would recommend utilizing a professional to help you make these decisions and do your research, and use a professional potentially when it comes to filing your taxes so you don't file wrong and get dinged with a 10% tax penalty. And for those who don't know, and if I haven't said it clearly yet, if you withdraw money from your own IRA or your own 401k or an inherited IRA, that's tax deferred money. If you withdraw that money before you're 59.5, there's a 10% penalty on the amount you withdraw. So if you have $1 million in your account, you take out $100,000 early, that's a $10,000 tax bill just like that, because the IRS doesn't want you touching your money before they tell you to. All right. Continuing on, the spouse beneficiary is treated as the owner, not a holder of an inherited IRA. as of January 1st of the year the election was made to treat the inherited IRA as their own. And this means they are permitted to make regular IRA contributions, perform Roth IRA conversions, and perform rollovers and transfers under the owner but non-beneficiary rules. Required minimum distributions for the spouse's own IRA would be calculated using the uniform lifetime table. That's the lower one, right? So that's the one that you can take, that you're forced to take less from because it's uniform kind of combined. Now deadline for treating his own. No longer can we tell spouse beneficiaries that they have forever and a day to elect the treat as own option for inherited IRAs. Instead, the proposed required minimum distribution regulations for Secure Act 1.0 explain the deadline for a spouse beneficiary to treat inherited IRA as their own is the later of 1, the end of the calendar year in which the surviving spouse reaches their applicable required minimum distribution age, and 2, the end of the calendar year following the calendar year of the IRA owner's death. If a spouse beneficiary misses the deadline to treat inherited IRA as their own, there is still hope, and they can roll over the amount instead. But any beneficiary required minimum distribution, it's a tough one for me, RMDs as they're known, must be taken before the rollover. Last option, the rollover option. A spouse beneficiary may roll over an inherited IRA to their own IRA. However, this rollover may not include required minimum distributions. The proposed RMD regulations explain that a spouse beneficiary who elects the 5-year or 10-year rule and later decides to roll over the beneficiary IRA to their own is subject to a hypothetical required minimum distribution. This hypothetical RMD applies if the amount being rolled over is distributed before the 5th or 10th year of the 5 or 10-year period, and in or after the year the spouse beneficiary attains the age at which RMDs must begin from their own IRA. This hypothetical RMD is the RMD that would have applied for years up to the year of the rollover had the spouse beneficiary elected to take distributions over their life expectancy instead of under the 5 or 10-year rule, and it is reduced by any distributions taken by the spouse beneficiary during those years. The 1099-R reporting requirements are the same as those that apply to the treat as own option once the assets have been rolled over. After the rollover, RMDs would be calculated using the uniform lifetime table. Note, a spouse beneficiary may also roll over eligible amounts to their own account under an employer's qualified plan like 403B or governmental 457B plan. Choosing the right option. So of all this information, that's probably hard to follow. I know I even get confused reading through it. I had to read multiple times. And in every single situation, I re-educate myself on what the options are and what we should be choosing for our clients. So don't feel bad if that was kind of confusing. Hopefully the main points of kind of stuck with you of 1, you have options, so know what they are. 2, I recommend talking to a professional and getting help or at least information about your specific situation before making a decision that could dramatically impact you either in a potentially negative way or your beneficiary in a potentially negative way when it comes to how much they have to distribute, when they have to distribute the money, and how much taxes they owe on the money. And 3rd, it's probably a good idea to have some help when it comes to filing the taxes around these accounts because there's a lot of different stipulations. So how do we choose the right option? A spouse beneficiary who chooses the beneficiary IRA option can move the assets to their own IRA later. But once the assets are moved to the spouse beneficiary's own IRA, there's no turning back. Therefore, the beneficiary IRA option should be chosen when there is uncertainty about which option is best. The assets, and that's also known as inherited IRA. So she goes on, she says the beneficiary or inherited IRA option should be chosen when there is uncertainty about which option is best. The assets can then be moved to the spouse beneficiary's IRA when tax beneficial. You'll notice that when a lot of times people think about investing from a return aspect, but one of the most important things that determines the amount of return you get is how much taxes you owe. So tax planning they kind of go hand in hand. Ultimately, she goes on to say which option is right for a spouse beneficiary depends on their beneficiary profile, including whether they need to avoid the 10% additional tax and or minimize distributions. All right, so I know that was a lot. Hopefully it was valuable and at least piqued your interest to talk to someone today or at some point in the near future about 1, who do you designate as your beneficiaries on your accounts? And 2, if it's your spouse, which of these 3 options is right for you? And if it's not your spouse, are those that you're leaving the money to aware of the 5 and 10-year rules and how it's going to affect their spending habits and their taxes? All right. So thank you so much for taking the time. If you stuck with me this long, I'm proud of you. that was a lot. Please let me know what you think by leaving a comment or reaching out directly. And if you're willing to share it with a friend or share it on your social media websites, I genuinely do appreciate that, because the more people I can reach with these videos and podcasts, hopefully the more value I can provide. And that's the goal of doing these. So thank you again so much for your time. I hope you have a great day, and happy Memorial Day this weekend. Please take a moment to remember the fallen, even whether it was a family member of your own, or just the idea that we wouldn't have the country we have today if it wasn't for those who fought for the freedom that we have. So thank you again. Have a nice day. Talk to you later. Bye.